So I think there are a couple of reasons. One is the obvious, which is where are you going to get a high level of income from? And closed-end funds, really regardless of what they're invested in, tend to have a mandate of offering high levels of income, whether it's from equities, from municipal bonds, from corporate bonds. So on a relative basis in a low-income environment, the fact that you're going to get a high level from a closed-end is attractive. And then in addition to that, a lot of closed-end funds employ leverage in their strategies. Leverage is obviously something that can increase risk, but it's also something that in a low interest rate environment is cheaper. Therefore, the opportunity to use productive leverage is that much greater in a low interest rate environment. So you'll see that closed-end funds tend to trade better when interest rates, or at least short-term interest rates, are headed lower. I think the way that we look at closed-end funds is really no different than the way that we look at our regular 40 Act open-end funds. And we tend to manage in similar areas across both open and closed-end funds. The way to approach it is, the way I've always thought of it is, there are various levers you can pull in a portfolio if you want to reach out for yield. Closed-end funds often yield-producing instruments. That's one of the things they're very well known for. And there are various ways that you can get to a higher yield. You can use leverage, you can use lower credit quality. And so the way an advisor should think about it is, what do I want to use in order to get more yield? Do I want to use the closed-end fund? Do I want a more aggressive high-yield bond fund that doesn't employ leverage and is open-end? So I think that the decision needs to start with, first of all, what's the asset class do you like? Again, we have closed-ends across many asset classes. And then what degree of risk do I want to take to attain my income goals in that? And then you have a choice of vehicles to choose from. The closed-end fund, we would say, would be a very good one. One of the great things about closed-end funds, and I think if you polled portfolio managers at Eaton Vance, they would say that the structure that they like managing the most would be the closed-end fund. And that's because they're not held to the continual inflows and outflows that we see in the open-end world. They have a stable base of assets which they get to manage for the long term, which is not, the prices obviously can move depending on the markets they're invested in, but they're not impacted, they're not forced to sell, say, in a market that's going lower because people want their money. That isn't how closed-end funds work. So from a portfolio manager standpoint, it's very definitely a benefit. From an investor's standpoint, really the same is true in that if a closed-end fund is invested in an asset class that is going lower, people are panicking and removing their money from that asset class. The NAV, the value of the overall fund, is likely to fluctuate. It's probably going to move down in that environment. But again, the manager that's looking after, that's stewarding those assets isn't forced to sell at those lower prices. They can wait for a recovery. They have a much longer term view, and therefore the chances of seeing that dip reversed are that much better, and there's no need to do any panic buying in the closed-end fund.